When you're valuing a company, what are the most important criteria or metrics you use in determining its intrinsic value?
Depends. It depends on the business. So it's I think different industries and different companies, uh, you have to use different yardsticks. So like for example, you know I used to own a company in China called Maotai, which makes premium liquor, and it's a business I should have held on to, but in my infinite wisdom, I sold because of the 50/90 and such. But I think Maotai went up over a 4 or 5 year period about 6, 7 times. And that's a business where uh, the cost of the product is, I mean, a bottle of uh, the Maotai Baiju is maybe their cost is $3, $4, and it goes for like $150. Um, you know, Anytime you have a business like that, you're going to do really well. And the $150 in a few years can be $300 because they've got this incredible brand, and um, uh, you know there's a massive growth of China backdrop, and it's a status symbol to be able to serve Maotai and so on. So when you're looking at a business like that, it's going to be quite a different analysis than, for example, when I looked at another business we owned. I think in 2012 we bought Fiat Chrysler, and so there the calculus was very different. So there we had a star manager. It was a business that was doing 130 plus billion in revenue and a 5, $6 billion market cap, and pretty much. Um, if they were able to just even slightly right the ship, and even you know eke out 2, 3%, 4% in profits, that stock was going to be a multi-bagger. So it just depends. Each business and each industry, I think you have to just, and the key is that you have to get to the factors that matter. Like I would say that if you look at a company like NVR, and every year they are taking 100% of owner earnings and putting it into buybacks, um, and you continue to own the stock, those owner earnings are not coming to you. Okay, you're owning a bigger and bigger portion of the pie, but you're not seeing any cash come to you, right? And so in that case, the thing that matters, all that matters when you own a business like that, is at whatever endpoint you want to look at. The question is, what are the shares outstanding at that endpoint, and what is the stability and cash flow of the business at that point? Because that's how the market would value it, right? Um, so it's a very different calculus from Mautai. It's a very different calculus from Fiat Chrysler. So each business that you're looking at, I think you need to look at. So the first question, even before you get to all those things, is do I understand the business? Is it within my circle of competence? Can I figure out the 2 or 3 variables that really matter? So, for example, one of the things about the NVR home building business is they don't start building a home till there's already a person who's bought it. Okay, so they don't build any speculative homes. So I go to them and say, I look at the model and say, yeah, that's great. I'll buy the home. We sign a contract. They see I have a bank loan, and that's when they start building that home. So, which means that they do not put any capital in till there's a confirmed sale, right? And the second thing about NVR is NVR does not own land, which is the biggest investment for a lot of builders, they have options on land. So they basically believe in just-in-time manufacturing, where they're saying all the factors of production that I need to build this home, I want to be bringing those together as close to the sale point as possible. So when you look at a business like that, what that means is that if the business ebbs and flows, which is the number of homes they build goes up and down with the economy and so on, it doesn't really matter as long as their core overheads are low. Okay, so let's say, for example, their corporate overhead, whatever, if they built 0 homes in a year, is $25 million, for example, right? So if they didn't build any homes, they would lose 25 million, for example. And if you can see that the balance sheet can handle that for several years, then you're fine. Then you know that if they build more than 1,000 homes, they'll make money, or more than 500 homes, they'll make money. You figure out the metric at what point they break even. And maybe they're building 5,000 homes a year, and the number of homes they build typically fluctuates between 2,000, 5,000. I'm just pulling these numbers out, and I'm not. NVR is a train, according to me, that left the station. But who knows? Maybe in the next 20 years they'll prove me wrong, where they'll buy back another 9% of their stock and be 1% shares outstanding. Anyway, what I'm trying to say is that each business is completely different. And so the key is, can you understand the 2 or 3 variables that are going to drive the outcome? And it's very important that you've honed in on those key variables. And usually the entrepreneur or the CEO running the businesses needs to be honed in on the same variables. So if you have gotten to the point where you can see the business and visualize it the way the CEO does, then it's typically that you've got the right variables.